Welcome back to The Explainer. Today, we are jumping straight into the wild cross currents defining the markets right now. We're taking a deep dive into the July 2026 price forecasts for the absolute heavyweights, Bitcoin and gold. And we're going to be exploring a massive question. Are we actually witnessing a historic decoupling as these two giants react to some seriously conflicting macroeconomic signals? Let's get into it. So, both Bitcoin and gold are surging on recent macro news. But is this a genuine new rally, or are we just walking into a trap? Both of these assets have seen some serious, rapid-fire price action recently. But if you look just underneath the surface, there is an absolute tug-of-war happening between the relief of bullish buyers and the harsh reality of some long-term bearish trends. Here is exactly what we're going to break down for you today. We'll start with the macro market setup, check out gold's battle with resistance, and then look at Bitcoin's relief rally. From there, we'll figure out if these mixed signals mean a trap or a bottom, face the reality of the halving cycle, and wrap up with the key levels you need to watch next. Okay, let's dive into Section 1, the macro market setup. Because honestly, to understand where crypto and precious metals are heading today, we first have to understand the macroeconomic ground we're standing on. And the market just received a massive shock to the system. Economists were forecasting a pretty modest addition of 110,000 jobs for June 2026 in the US. Instead, the actual data came in at a totally dismal 57,000 jobs. The US economy dramatically missed those expectations. They essentially cut the forecast right in half. Now, you might be wondering, what does that actually mean for the markets? Well, that dismal jobs report instantly rippled through the financial system. Because of the weak labor market, the probability of a September rate hike by the Federal Reserve suddenly dropped down to 56%. And when the likelihood of higher interest rates fades, non-yielding assets like Bitcoin and gold suddenly look a whole lot more attractive to investors. It acted as a massive bullish catalyst. Moving on to Section 2, gold's resistance battle. Let's see exactly how this macro shift impacted the price action for the world's oldest safe haven asset. In direct response to that macro news, gold gapped up with just incredible momentum. It surged rapidly, touching a 2-week high and striking a massive psychological resistance level of exactly $4,200 per ounce. But we do need to sober up a bit here. Despite that really impressive short-term pop, gold immediately faced intense selling pressure and quickly settled back down near $4,145. So the absolute crucial point here is that despite all the excitement, gold actually remains trapped inside a medium-term bearish trend. It's sitting firmly under both its 50-day and 200-day moving averages. So yeah, it was a bounce, but for sure, not a breakout. Which naturally brings us to the question on everyone's mind. Is Bitcoin facing that exact same resistance? Historically, gold and Bitcoin tend to move together during macro uncertainty. But today, we really need to see if digital gold is mirroring physical gold or if we are actually witnessing a historic decoupling between the two assets. Let's get into Section 3, Bitcoin's relief rally. The digital asset market has had a truly turbulent few weeks, recently plunging to a grueling 21-month low. But those same macroeconomic shifts we just talked about, they offered crypto a sudden lifeline. And that lifeline pulled Bitcoin right up to $63,248. The asset managed to consolidate above the critical $62,000 mark and hit this highly specific price point, completing what analysts are calling a much-needed local recovery phase. So what drove this? Well, 3 distinct triggers fueled Bitcoin's recent upward momentum. First, as we just discussed, the weak U.S. jobs data softened the dollar. Second, we finally saw the return of inflows into spot Bitcoin ETFs, snapping a brutal 10-day streak of outflows. And third, MicroStrategy aggressively stepped in again, buying $1.25 billion worth of Bitcoin to replenish their reserves. Put them all together, and you've got a really powerful cocktail of bullish catalysts. Which brings us to Section 4, mixed signals, trap, or bottom. This is the core debate of our explainer today. We have to weigh this short-term technical recovery against the undeniable medium to long-term bearish reality that's currently hanging over the market. And this brilliantly illustrates the massive technical conflict we're seeing right now. On the bullish side, the daily time frame shows Bitcoin reclaiming the 20-day moving average, and momentum indicators are actually flashing positive, showing selling pressure is drying up. But the bearish reality? It is stark. The price is still stuck under the crucial daily moving average ceiling, the EMA 50, at $65,738. Plus, hourly indicators are warning of a fresh downward cross. So we have a daily outlook hinting at recovery, clashing with an hourly outlook screaming danger. This extreme market tension is perfectly captured by a single number, 24. The crypto fear and greed index is sitting right at 24, which is deep in extreme fear territory. Despite the recent price bounce, this tells us the broader market is still incredibly uncertain and absolutely has not found a confident psychological bottom yet. That skepticism is expertly captured by the crypto market maker Keyrock. They noted that thin holiday liquidity and ETF outflows suggest this move is just short covering. In plain English, this price jump isn't eager new buyers flooding into the market, it's mostly traders who bet against Bitcoin scrambling to close their positions. All right, Section 5, the halving cycle reality. Let's zoom out from the hourly noise for a second and look at some massive historical perspective provided by Simian XAI data. The stark mathematical truth of Bitcoin's 4-year cycles is pretty undeniable here. Check out the multiplier columns showing the return from halving day to the cycle peak. Cycle 1 delivered an insane 103x return. Cycle 2 dropped to 30x. Cycle 3 was 7.9x. By cycle 4 today, we are tracking at a mere 2.0x. The explosive returns of the past are demonstrably shrinking. Which brings us to this vital, somewhat sobering takeaway. The halving cycle is still firing, but it's landing with a smaller punch every single time. Yes, the hard-coded reduction in supply still matters, but in a mature market flooded with Wall Street ETFs and heavy corporate treasuries, the explosive, face-melting impact it used to have on price is steadily fading. Let's wrap things up with Section 6, key levels to watch next. Let's bring our explainer back to the immediate term and give you the actionable July 2026 price forecasts you need to navigate the week ahead. Both gold and Bitcoin are incredibly sensitive to these upcoming risk factors. We need to be watching the release of the FOMC meeting minutes and listening very, very closely to any Federal Reserve rhetoric. If the Fed suddenly sounds hawkish again, we could see a stronger US dollar. That would instantly cap the upside for both markets, while any renewed spot Bitcoin ETF outflows would add heavy localized pressure specifically to crypto. So for Bitcoin to actually confirm a true trend reversal and not just a dangerous dead cat bounce, it must clear 3 strict hurdles. Step 1, it has to hold the support line at $62,565. Step 2, it needs to confidently break the primary resistance at $63,900. And step 3, the ultimate confirmation. It must reclaim that critical ceiling, the daily EMA 50 at $65,738 with solid volume. And for the precious metals watchers out there, gold's hurdles are just as clearly defined. Step 1 is to maintain that immediate support around $4,145. If it can hold there, step 2 is mounting a successful attack to finally clear that heavy, psychological resistance at $4,200 an ounce. That is the exact threshold needed to shift momentum back into the buyer's hands. Which leaves us right here. The macro tides are clearly shifting. But with Bitcoin's historical returns shrinking and extreme fear lingering in the market, are we watching a historic decoupling, or will both of these assets eventually fall victim to the exact same trap? Are you playing the bounce or preparing for the drop? It's the multi-million-dollar question for our July 2026 forecast. Keep a close eye on those levels, stay focused out there, and I will catch you on the next edition of The Explainer.